Hello everyone, this is Rahul Jakaria from Sharekhan. Welcome back to exciting 3R actionable stock updates. 3R basically means right sector, right quality and right valuation. These are our investment ideas. Today we have an update on Dabur India. Our analyst maintains buy rating on Dabur with a revised price target of Rs 615. Dabur's quarter 4 numbers were ahead of our expectation, mainly on account of higher than expected operating profit margin at 16.6%. Revenues grew by 5% year-on-year, where domestic volume growth of 4.2% was seen, and profit after tax grew by 16.6% year-on-year, like for like by 22.7%. The company's growth in rural markets stood at 8% versus urban growth of 4%. Dabur expects rural growth to improve with likelihood of a better monsoon and sustained support through government initiatives. Management targets revenue growth of high single digit to low double digits with mid to high single digit volume growth. Operating profit margin would stand at 20% in FY25 and will consistently improve in years ahead. Stock is corrected by 12% from its high and is trading at 43.5 times its FY25 and 36.7 times its FY26 estimated EPS. Recovery in volume growth will be key re-rating trigger for the stock. Next, we have an update on Cholamandalam Finance. Our analyst maintains buy rating on Cholamandalam Finance with a price target of Rs 1500. The company reported a strong performance in quarter 4 on all fronts except OPEX ratio was elevated. Core profit before tax grew by 20% year-on-year and 20% quarter-on-quarter, led by lower credit cost and higher net interest income and fee income, offsetting higher OPEX. Strong performance across its existing product lines and scaling up of new business segment resulted in robust AUM growth. This is likely to sustain its rich valuation on account of higher growth potential and steady return ratios. The company is likely to deliver a consistently sustainable ROE of 20%, healthy AUM growth, bottoming out of margins and contained credit cost should translate into a healthy earnings trajectory going ahead. Moderation in OPEX growth is expected over the medium term. It has well managed early delinquencies arising in its CSEL business and taken timely corrective measures. We take comfort from the company's historic execution track record on asset quality front. In the past business cycles, the company has performed well, which provides comfort in the quality of its high growth. The stock has outperformed the broader indices in last 1 year and it currently trades at 4.4 times its FY25 and 3.6 times its FY26 book value estimates.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.